QuickBooks Pro Plus Desktop 2022 OneNote Presentation, Advanced Customer Payment or Unearned Revenue, Method Number 1. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction, 8140, Advanced Customer Payment or Unearned Revenue, Method 1 tab. Also, take a look at the Immersive Reader Tool, topic introductions in the text area 2. Same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're looking at the home page to start off with, and we're thinking about the situation where we get an advanced customer payment, which is often a situation when you learn accounting concepts where you would have the unearned revenue type of calculation. It's going to be a little bit unusual in that the normal cycle for most companies will not have the receipt of the payment happening before they do the work. Typically, it will happen at the same time they do the work, or it will happen after they do the work. So here's our normal flow. We've got the invoice, we've got the received payment, and then the deposit, or we get paid at the same point in time with the create sales receipt, and then we make a deposit. But what if we get paid by the customer first, in essence getting this received payment before we create the invoice? When would that happen? Couple types of situations or types of industries that would happen in. Classic examples, newspapers or magazine industries, where basically you have a subscription model, which also applies these days to computer applications, where you're going to get paid first before you give them access to the application. In theory, then, when you get the money, you shouldn't be recording it as revenue because you haven't provided the goods or services in that case, and therefore you should be increasing unearned revenue, and as you provide the goods and services, decreasing unearned revenue, recording the other side to revenue when it has actually been earned. You also have situations where you have like real estate, where you might have a down payment, which kind of acts like as an unearned revenue. You got paid, but you didn't actually do the work, or you might collect like the last month's rent or something like that, which is another common area. And if you have a concert or something where you have a show that's going to happen, you're going to collect the ticket revenue before you actually have the show. And then in our instance here, we also have a situation where if we're going to be creating or ordering something that is expensive and somewhat custom in nature, we might ask for a down payment. So in our case, we're going to imagine we have a guitar, someone comes in, we don't have the guitar on hand or the correct color, or we got to get to it, but we want them to lock in, to commit to it, to make sure that it's worth our time to go through the process of completing the order for them. Therefore, we're going to ask for a down payment. When they give us the down payment, it's going to be a prepayment, meaning we received the payment before we issued the invoice. Now, this gets a little bit tricky because when you think about this and you're just thinking about debits and credits and how to properly record this on the financial statements, and if you've had accounting background, you're going to say, well, that means that you should be increasing cash, debiting cash, and then crediting not sales, but unearned revenue, a liability account. It's a liability because you have not yet done the work. You owe them the money back, or you owe them the work. However, that liability account is a bit of a problem logistically in accounting software, because I want to track this information by customer using the customer subledger. And the customer subledger is tied to accounts receivable, and in that way I can tie it to the invoice. The liability account is not tied to the subledger, and that becomes kind of an issue. So many companies will do an adjusting entry process a little bit different for unearned revenue than you might see in an accounting textbook. They might simply enter the received payment here, which will create a negative receivable instead of a positive liability. And so you'll have these negative receivables for these deposits in place, which works good logistically because then I can enter the received payment and then enter the invoice, which will map out and tie to the received payment. And that works quite well within the QuickBooks system, and the subledgers look nice. However, the reporting isn't quite right at that point. However, you can adjust it by doing adjusting entries at the end of the month or the year, and just plan to make an adjusting entry, increase in accounts receivable, other side going to the liability account, on a periodic basis. So that's the method we'll start with first because it's used in practice often. It's probably more unusual to people that have an accounting background. And then we'll do the second method, which is going to try to deal with the problems within the logistics of the software and still correct or record correctly to unearned revenue at the point in time that you record the transaction. So the impact here is going to be, we got the payment in advance. It's going to be a negative receivable, decrease in the receivable, and then unearned revenue is going to be going up because it's going to be a payment form. Here's the payment form. We're going to take it to Anderson Guitars, $300. Normally there's an invoice down here that we're going to tie it to, but we don't have one. That means when we record it, it's going to record what the system will call a credit to, meaning an overpayment to that particular customer that we can then apply out to the invoice, which is nice. Again, that's what we want to be able to do, is be able to tie it out to the invoice once we issue the invoice. So it says here, a credit for the overpayment will remain on the customer's account. You can, so that you could print this and so on. So it's going to say, yeah, it's going to have a credit. So that then decreased the accounts receivable, even though it doesn't have anything on the subledger to tie to in terms of an invoice. And then the undeposited funds went up. So here's the subledger. So now we got this 300. Here's this negative receivable. That doesn't mean the total accounts receivable are negatives, but for this particular customer, we got this one payment that doesn't match up to any invoice, which isn't a problem after we match it up to the invoice, but is not exactly correct for that particular item in accounts receivable. It should rather be a positive liability, but it works good logistically. Let's do it again. This is for Eric Music. Once again, we have a payment before we got an invoice. There's no invoice to tie it to, and it's going to say, hey, we're going to make a credit for this person because there's no invoice, and we're going to say, that's fine, that's what we want. So now we entered this before doing this, and we also have the deposits on the right-hand side that are in undeposited funds, represented by that number 3 over there. Accounts receivable went down, undeposited funds went up. So here's the other one. I think it was Eric Music. There's the 200 negative amount, which is funny looking on the subledger, but it does work logistically. And then if we go to the deposits, we make the deposits as we've seen in the past, taking it out of undeposited funds and putting it into the checking account. Undeposited funds going to 0, checking account then going up. So if we then look at this in terms of journal entries, this is what the journal entries will look like. So we got a payment in advance. We debit the undeposited funds and credit the accounts receivable. This credit to accounts receivable is the funny thing. So we got the undeposited funds go up, the credit goes to accounts receivable. You would think from an accounting standpoint, if I was just doing this with debits and credits, I would put it down here to a liability account because it should in theory be a liability. So when you see it on a debit and credit side, there's nothing stopping me from doing that. It's really easy to do that. But when you see it on the software side of things, you're saying, yeah, but then my subledger I can't really tie out the subledger because I want to tie out the payment to the invoice. And I can't do that when you're basically putting customer stuff in a liability account. The customer stuff needs to be up here in the accounts receivable account. And that's why we've got this negative receivable. This isn't really the natural thing to do from a debit and credit standpoint, but from a logistics software standpoint and the subledger, it can be an easier thing to do. Let's see why that isn't down here. We've got then the undeposited funds went up by 300. The accounts receivable went down. If we look at the subledger, here's Anderson, which got this negative receivable. This is where the reason why we might do it this way, because this subledger now allows us to track that payment by customer, which ties out to the accounts receivable account, which we don't, the subledger for the liability does not. So the payment that we have in the subledger here will then net out to that amount. Total of the customers adds up to the 19,511, which adds up or ties out to the trial balance. If we did this 2 more times, same kind of concept here. We did the same thing for 3 customers, and then the the undeposited funds, we got the 300, the 250, the 200 went up to 750, and then the accounts receivable for the 300, the 250, and the 200 went down to the 1961. So now we got these 3 customers, the 300, the 250, and the 200 for Eric Music, Smith Guitars, and Anderson Guitars, which all have these negative kind of amounts that aren't tying out to any invoices. And so that adds up to the 1961 for all of our customers, which ties out to the accounts receivable general ledger. And then if we just transfer from the undeposited funds into the checking account goes up by the 750, undeposited funds go down. If we look at the subledgers, checking account then was at the 102,852, goes up by 750 to 103,602, And the undeposited funds was at 750, down by 750 to 0.